With the tax deadline approaching, it's past time to get your papers in order. Here's how to make crypto tax filing as painless as possible. The deadline for filing tax returns for the year 2021 and paying any taxes due is April 18, 2022. All Americans must now declare whether or not they have transacted in Bitcoin, according to the IRS. Did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency at any time during 2021? Ask the question at the top of Form 1040. Don't be fooled by the words. The IRS refers to crypto as virtual currency. Despite the fact that it does not consider crypto to be a currency, it is treated as a property for tax purposes, similar to stocks and rental properties. The IRS issued warning letters to suspected crypto tax evaders last year, so it's never been more important to double-check your documents. Fortunately, there's a lot you can do this year to ensure a seamless crypto tax experience. Here are some of our best recommendations. 1. Don't try to disguise your cryptocurrency transactions from the IRS. Let's start with the facts. If you believe the IRS doesn't know what you're doing on Uniswap, let alone centralized exchanges like Coinbase, think again. Then you're mistaken. A KYC, Know Your Customer, mechanism is in place at all major cryptocurrency exchanges. Your crypto exchange will link your banking details to you when you pay in fiat with a debit or credit card, or a bank wire. The IRS has already used the so-called John Doe summons to compel crypto exchanges to reveal all of their customers' personal information. When you withdraw funds from a centralized exchange into an Ethereum address, for example, that Ethereum address is linked to your KYC-ed exchange account. In March 2021, the IRS started Operation Hidden Treasure, a specialist team tasked on discovering unreported crypto from the blockchain's darkest corners and holding taxpayers accountable. So, if you believe the IRS isn't technologically sophisticated, think again. It almost certainly employs more crypto experts than your Telegram channels. 2. You are responsible for your own crypto tax. President Biden signed a $1.2 trillion bipartisan infrastructure plan into law last November, which includes a provision requiring so-called brokers, such as cryptocurrency exchanges, to furnish 1099-B tax forms. However, because the law takes effect next fiscal year, don't expect tax forms from your exchanges, though some may choose to send you one freely. In any case, crypto exchanges, or anybody else, for that matter, have no obligation to help you prepare your crypto taxes and file them on time. It is all your responsibility. You can make submitting your crypto taxes less time-consuming and more precise by using software like Coinly, which offers a choice of free alternatives to make the process easier. 3. Reveal how you got around paying crypto taxes in the past. The Internal Revenue Service has been delivering letters to crypto dealers and investors who are suspected of underreporting or dodging taxes. These letters are designated as 6173 and 6174, No Action, Educational, or 6174A, No Action, Educational, Action Required. What if you didn't file your crypto taxes last year, or if you did but underreported them significantly? In the worst-case situation, you might face a fine of up to $25,000 as well as criminal charges that could result in up to 5 years in prison. The best way to avoid such bleak prospects is to proactively report and cooperate with the IRS. The IRS has added a section on reporting cryptocurrency to Form 14457, the Voluntary Disclosure Practice Pre-Clearance Request and Application. If the agency hasn't taken any legal action against you, you can use Form 14457. 4. Comprehend the fundamentals of crypto taxation. Your cryptocurrency is taxed in one of two ways. If you earn cryptocurrency, you must pay income tax on it. Play-to-earn games, such as Axie Infinity, or airdrops, such as the Ethereum name service, could provide crypto profits. Crypto is also liable to capital gains tax if you sell, swap, or spend it. DeFi and NFTs are subject to the same tax requirements as centralized exchange Bitcoin transactions. It's admittedly more difficult to figure out which tax regulation applies to them than it is to figure out which tax rule applies to cryptocurrency trades. It's not all black and white, and there are numerous shades. If you don't want to learn the tax code that applies to crypto, you may just use crypto tax software like Coinly. 5. Long-term versus short-term HODL. Understanding the principles of crypto tax can help you not only report and pay taxes, but also reduce your tax burden if you establish a strategy around it. Here's an example of what I'm talking about. Cryptocurrency kept for more than a year is subject to the long-term capital gains tax. If you keep it for less than a year, however, you'll have to pay short-term capital gains tax. Because it's the same as your income tax rate, it's a less favorable tax rate. If all other factors are equal, you'll want to keep crypto for more than a year if you want to save money on taxes. 6. Choose your cost basis carefully. At first glance, the tax code appears to be onerous. There is, however, a lot of wriggle room. Your cost basis, or how you calculate the original price of your crypto investments, is one area where you have control. You can choose from the following options. FIFO, first in, first out, is a first in, first out. LIFO, last in, first out, last in, first out. HIFO, high intensity focused, highest in, first out. ID of the specification, specific identification. It's a bit of an alphabet soup, and each one has its own set of advantages and disadvantages. In a particular tax year, you can only choose one and stick with it. The simplest approach to do this is to use a tax software like Coinly to conduct simulations of your tax burden while experimenting with different cost basis options. Then choose the one that appears to be the most tax efficient for your needs. 7. Losses are important as well. When it comes to taxes, it's not just about the profits. You can deduct up to $3,000 in net capital losses from your capital gains. You can also deduct your net capital loss from your personal income if you have more capital losses than gains. Isn't it possible that part of your crypto investments have gone to the goblins? So, by realizing losses, you can take benefit of this. Remember that unrealized profits and losses are not taxable. 8. Tax loss during harvest. Tax evasion, or failing to pay required taxes, is prohibited, as previously stated. Tax avoidance, on the other hand, is a legal and widespread activity that involves strategically reducing possible taxes. Wash sales, in which investors sell an asset at a loss and file a capital loss for the tax year, only to buy it again later, are one strategy to reap tax loss. The IRS has a wash sale rule that says you can't claim a capital loss if you buy back a substantially similar item within 30 days. However, for the time being, the regulation only applies to securities such as stocks and bonds. Cryptocurrency is seen as a commodity rather than a security. 9. To make the filing process easier, use tax software. You'll need to keep track of all of your trades across self-hosted wallets, centralized exchanges, DEXs, NFTs, and other platforms in order to file your crypto taxes. It's difficult to keep meticulous records of all those transactions, especially if you've dabbled with DeFi using tools like liquidity pools and flash loans. Thank you for watching. Please subscribe for more Crypto Secrets Move.